180 per pound. It's above the strike price. Why wouldn't they exercise the option to sell the pounds at $1.75 a piece? Less money than doing what? If they exercise, they get 175. They get the 1 million pounds. What's their other alternative besides exercising? What can they do with the pounds? Just exchange them, right? So why exercise? You take your pounds down to the bank. Hey, here are my pounds. The bank would give you $1.80 for every pound. So the market would pay you much more than exercising. But we also have the possibility of unlimited gains because we can take advantage of the rising value of the pound. Okay. Now I think we may be ready for questions. Hopefully. Is there any questions about the uncovered position? Does everyone see why that is very uncertain? We just have to wait and see, don't we? Okay. Does everyone understand going to the bank and getting the forward market? Which would you prefer? What is your risk tolerance?
I prefer money market hedge.
You would prefer the money market hedge. Why was that?
Because this is straight line horizontal, so it doesn't depend on which exchange rate will be after 80 days. So we see that we'll have 1.78, so we'll have a profit. And this is more than forward contract hedge.
Okay, so you prefer the money market hedge because you're looking at this horizontal straight line, which achieves certainty of your cash flow. Right? So you've taken away the risk of a varying cash flow. And secondly, you like this line because it's higher than the forward contract amount. Okay, under the assumption, however, right, that you can take that money that you borrowed in pounds, convert to dollars, and use as an opportunity cost in the firm. Therefore, you can value it for 90 days at the firm's cost of capital. Because if you had made the other assumption, that you just put it in an investment account at 6% per annum, where would my line be? Above or below the forward contract?
How many percent? 6?
Yes, 6%, 1.5% for 90 days. Right? We did the calculation, I believe. Right? 1,746,791. So compared to the forward contract, which we locked in at what? 1.754, didn't we? So 754, the forward contract would be greater than the assumption in the money market hedge if we use just the investment account. So therefore, with that assumption, this line would move below that, wouldn't it? Okay, so it depends on which assumption. And we also calculated to have this line and this line be the same line, the break-even rate that we'd have to receive on those funds for 90 days would be the 7.68%, I think was the rate. Okay. So the money market hedge line, oops, here. Okay. This Russian technology. Okay. So where the money market line hedge is in the graph depends upon the reinvestment rate assumption. Right? The assumption we make, what we can do with the funds. Okay. Do we have any questions about the black lines on the graph, which represent the options? The difference being, we create a floor value if the pound goes down in value, while leaving the upside potential that if the pound goes up, we will benefit. So do you see the risk trade-off here? Would you be willing to accept a lower bottom amount, okay, to create some upside potential? It's a different mindset, a different attitude towards risk. Yes, I'd accept a little bit less with the opportunity that I could make more money. And it still meets my objectives, which was, I believe, what, $1.7 million. So it just depends on management, whether or not you're terribly risk averse or a little more risk. Yes?
It was options, so both ones. This is when we buy bonds, options.
This option, this is a put option. It's an option to sell pounds. Because our business, we're receiving pounds. The English company is paying me pounds. I don't want pounds, I want dollars. Right? So therefore, in the financial markets, I need a way to get rid of these pounds and give me dollars. So the option would be a put option, the option to sell pounds, to get rid of the ones that I'm going to receive. On the other hand, had this been, if we have time today, if not, you can read in the notes, this could also be an account payable. Right? If I had to pay pounds to an English company on something I had bought, then the option I would buy would be a call. Because I want to lock in that I have to buy pounds in the future to use to pay this English company. So on an account receivable, it's a put. An account payable, it's a call. Any other questions about the options involved? The only other thing to remember is that all of the valuation takes place when the receivable is due, or the payable is due, at the end of the credit period. In this case, 90 days.